Let's bring in Emily Roland. She's the co-chief investment strategist at John Hancock Investment Management. Emily, welcome to you. It's the big debate. U.S., international. International's been outperforming. What do you think?
Yeah, it is remarkable to see the outperformance in international equities. And we look at it as a momentum trade that's not fully supported by fundamentals. We're still seeing a relatively better economic picture in the United States. Tom just talked about that. We're seeing a relatively better earnings picture here in the United States, yet non-US markets are absolutely ripping. A lot of that is based on some geopolitical developments. Markets are just so myopically focused on what's happening from a geopolitical perspective that the fundamentals are sort of being left to the side right now. We're seeing huge momentum and potentially even short covering in non-U.S. markets. We continue to lean into U.S. markets given the fact that there's better quality here. And again, more opportunities to look at areas that offer some value at a reasonable price.
Yeah, so you think U.S. equities are cheap, but not many, even with the correction we've seen, a lot of people still think things look a little bit overvalued or frothy, or I don't know. I mean, we have come down sharply and quickly, so maybe the picture is changing.
Yeah, I mean, cheap is probably a stretch, but we went from about 22 times forward earnings to now 20 times. We're also seeing a healthy reset in terms of earnings estimates. Analysts had been penciling in about 15% earnings growth in the United States this year. That's more like 11%. We think that's likely more in the ballpark. We're also seeing some really healthy breadth develop across markets. U.S. mid caps, which is an area we've been favoring from some time, are holding in the best across the style box in the United States. We're seeing sectors like healthcare do well, consumer staples. So we want to look for those opportunities to rotate into higher quality areas, more defensive areas, stocks that are paying dividends. We like things like infrastructure equities, which should benefit as demand maybe starts to recede a bit in terms of consumer spending, but we're still going to see that more consistent demand for areas like infrastructure.
It's interesting you mentioned mid caps. That's been one of the top picks on this program the past several months. People kind of going to that strategy, and that's working. The dollar is an interesting one here because all of a sudden it's weakened pretty significantly from the highs. Does that have to continue to be kind of part of the idea that you should actually tilt back towards the U.S.?
Yeah, Kelly, that's an important point about this narrative. A good chunk of the non-U.S. equity outperformance has come on the back of the weaker dollar, which is down about 5% since its peak in early January. What's really notable is, again, the U.S. large cap underperformance. Large caps should actually be helped by a weaker dollar because 40% of the revenues of U.S. large cap companies come from overseas. We're also seeing rates coming down slowly. That means there's a lower cost of capital for those U.S. large cap companies. So there's a few positive developments happening here from a cross asset perspective that probably aren't being noticed as much by investors that are so focused on geopolitical developments. So U.S. quality, which has been expensive for a while, is actually starting to look like it might be on sale, and we're looking for opportunities to lean in.